So welcome to another week of Lunch Money. We do these every Thursday at lunchtime, and they're available as a podcast on Spotify, Apple Podcasts, and Google Podcasts. But thanks to everyone who's joining in live today. So I'm Sonya, one of the co-founders and CEOs of Sharesies, and this is Gus. He's our Head of Investments. And today we are joined by Brad Olsen, who's the Senior Economist and Director at Infometrics. We've had Brad on before, and so really looking forward to getting in and having another chat with him about how things are going. So just a reminder, if you have any questions for us, please submit them through the Ask a Question button below. We don't typically look at the chat, and so if you do have questions for Brad, please ask them there and we'll make sure we cover them at the end. Just a disclaimer as well that nothing we talk about here today is personalized advice or recommendations. It's just general and only current at the time. So also please be kind and respectful towards our speakers and also our fellow viewers. Otherwise we will have to remove you from the webinar, which we hope we don't have to. So now we will bring Brad on and introduce Brad. So as I said, Brad is a Senior Economist and Director at Infometrics. He's got a lot of strings to his bow. He's also a Justice of the Peace. He volunteers with an organisation called Take 10, and he recently won the Youth Welly Award at the Welly Awards. I think it was only a few weeks ago. I was there. He's also, in 2016, was announced as New Zealand's Queen's Young Leader, and has actually met the Queen 3 times. So really excited to have Brad. Have we got Brad?
Hi, team.
Here he is. Kia ora, Brad.
So nice to be back.
Yay, so great to have you back. Thanks heaps. So I've given a little bit about you, but always interesting to hear it from yourself. So before we get started, can you tell us a bit about you and your story?
Yeah, and I'll try to keep it brief. Look, grew up in Whangarei, first 18 years of life up north. Yes, there is something above Auckland for those of you that haven't explored the country in the last wee while. Moved down to Wellington for university, stayed there ever since, started working for Infometrics in the background, doing some data work, typing numbers into spreadsheets, and it's sort of snowballed since then. With the COVID changes coming through last year, I started to do a lot more commentating. What's the economy doing? What do we think's coming next? And just trying to make economics as simple and understandable as possible. People are making big decisions at the moment, and trying to make sure that they're as well informed as possible is good. I was going to say my spare time. Spare time is probably a little bit hard to call it that. Like you say, try to sort of support my community in as many different ways as I can, which is a fun and fulfilling life, we'll say.
Yeah, cool. And so can you tell us a bit about what you do at Infometrics?
Absolutely. So a lot of the time is very much trying to figure out what are the next big trends, how are we seeing the economy move, but in New Zealand trying to break it down in terms of what's happening in the regional economy. So is Auckland performing well? How's Otago going? All those sort of things. What the different industries are moving and shaking like. At the moment we've got some big changes there. Tourism still hard hit. The primary sector though doing quite well. Construction is gangbusters, but apparently there's no more wood. Just trying to figure out sort of all those different little bits and pieces, advising, decision makers at a regional level, advising big business, advising government every now and then about what we're seeing, what's important, and what we think is coming next.
One sec, I'm just trying to get my mute off. Hey, welcome everyone. Yes, I'm Gus, Head of Investments here at Sharesies, and I've got a couple of housing questions first for you, Brad. So last week on Tuesday, there was the government's housing announcement. Are you able to tell us a bit around these recent policy changes and what it means for Kiwis going forward?
Yeah, absolutely. I mean, last week's announcement was quite big. Some of it was well signalled. We knew it was coming. Some of it really wasn't. So to break it down, there's sort of four main policies that came out last week. There was the change to some of the first home grant caps. So now people can earn a bit more and buy slightly more expensive houses if they want to get some government support. There was a $3.8 billion infrastructure fund that the government brought forward that's trying to get pipes into the ground for new land, so that when developers want to build a house that they can actually connect the services to it. That's supposed to unlock a bit more development. There was the extension to the Bright Line test. So at the moment, you have to pay tax if you sell a house that's not your family home within 5 years. That's being pushed out to 10 years. The exemption being that there's no extension to that test if you build a new home. We want to get more houses built in the country. And then the big one was that the government is removing interest deductibility from investors. So it used to be that your interest payments on your mortgage for an investment property, you could essentially treat them as a business cost and reduce your taxable income. That's no longer the case for new investors, and over 4 years they'll phase it in so that no investor can have that interest deductibility, again aside from if it's a new build, because the government's trying to screw the scrum away from investors towards first home buyers and trying to make sure that we're building more.
Cool, thanks for that, Brad. So the reason for this policy announcement and the changes is this housing affordability problem in New Zealand. Are you able to address, do you think these changes will be able to address this problem, and does it fall short or does it miss the mark? Is it targeting the right people? What are your thoughts on that, please, Brad?
It's a start, and I think that's a big an important part of it, that we're doing something about it. We've talked for a long time. We're starting to get some action underway. It's not going to make houses affordable overnight. To be honest, if you want houses to be affordable, you either have to have house prices fall, or all of our incomes have to go up a fair bit. To get affordability down from the current 6.7 down to 5. Now 5's still not that affordable, but better. You'd either have to have a 25% drop in house prices or a 34% increase in income. So, these things take time. We were never going to solve the housing market issues overnight, but this starts to get us in the right direction. What I think is challenging is that it hit investors hard. Investors were the losers when it comes to that housing announcement. I don't know if anyone really won. First home buyers didn't win, they just didn't lose in a sense. So it starts to address some of the issues, but it's not the silver bullet that's going to fix the housing crisis.
Yeah, very interesting. Lot of moving parts here, aren't there? One of the other pieces I heard you talking about on the radio actually was around rent levels and what this might do to rent levels.
Yeah, so there are some interesting changes coming through in terms of what investors are saying they might do. Essentially, from an investor point of view, making your rental work financially has gotten more expensive because you can't, offset some of your costs. Those interest deductibility changes were quite big there. So what investors are saying is, look, we're going to have to put up rents to cover this change in cost. In our mind, that's not quite as likely. We see there to be some pressure on rents going higher, but that's limited because people probably can't pay a huge amount more for their rents. So even though we've seen house prices go up, 20% over the last year, rents have only gone up 3 to 4%, broadly in line with where wages have moved. And that's because people just simply can't afford a huge amount more. So we think there's a bit of a cap on just how much landlords can continue passing on. At the same time, there are going to be some landlords that are, this changes the equations quite a lot. They're going to have to make up their money somewhere. They're either going to have to sell out of their property because they can't make it work, or they're going to have to charge someone somewhere something more.
And so, pretty much as long as I remember, housing's been talked about, and the housing crisis, house prices going up, and this has happened over several decades now. And it's not the first move that's been made from a government. Are you able to tell us how this one might differ from previous moves?
Yeah, I think what we're starting to see is that there is that slow momentum building to try and get activity going. What I was surprised at was that today, last week's announcement was focused quite a lot on who can buy houses, what's the financial attractiveness of investing in the housing market and similar, where the focus in my mind still needs to be on just building more houses. If we address the supply issues, if we open up land, that's how we start to eventually solve the crisis. So the $3.8 billion I talked about before, that was the big one for me. That said, we're addressing issues where councils haven't been able to fund infrastructure and similar. But it also says, look, we're 3 to 5 years away from really making too much of a dent in this housing crisis and getting people into homes. So I think, compared to other times, we've taken our head out of the sand, which is an important step. Now we're sort of casting our eyes around, trying to figure out which direction we run in. The difference has been that we've gone from not caring about the problem, not addressing the issue, to starting to address it, but we're not at the finish line yet. We've only just sort of rocked up to the start line.
Oh, that segues really nicely into my next question, I think, then, a two-pronged one. So what more do you think we can expect from the Ardern government? And then if you're an economic advisor in Jacinda's ear, what would you be asking for?
Yeah, I think we can see more coming through from government, but I think there's only so much that they can do in a sense to keep things going. They'll be focused probably a lot more on what they might be able to let the Reserve Bank do. So the Reserve Bank earlier this year announced that it was going to re-implement its loan-to-value ratio restrictions. So again, putting a bit more of a speed bump in there for some investors. We expect that they might also introduce a limit on just how much interest-only lending can go forward. So instead of having to repay any of your principal, a lot of investors just pay off the interest month by month. So that's a change we think could come through. I'm sort of a little bit limited in what I think the government could do more of, and this comes to the second point. If I was an advisor, I'd be keen to keep the government building, but I don't know about you guys, but no one I've talked to can find a builder at the moment. There's no spare land around, it's hard to get a chippy. We've got no wood in the country, apparently. All of these changes sort of say that, look, there's nothing you can do to click your fingers, bang, we've magicked up some houses. What I would advise the government to do is to keep working on sort of making sure we do have a good talent pool coming through. So let's train up some more apprentices. Let's make sure that the government is willing to build its own state houses at scale. Let's make sure that we've got, as easy consenting rules as possible, so that, look, the big one for me is that when you walk into a council building and you say, I want to build, you should be throwing a party and given a bouquet of flowers and that. And at the moment, everyone sort of says, well, look, here, I'm going to slap 300 pages of documents in you and make it really difficult to develop. So we've got to sort of change that mindset. But the core message here is that nothing happens quickly. If you let up an issue build up over 30 years, it's going to take more than a year or two to fix.
Very interesting. And so at Sharesies, we're a wealth development platform, and currently we offer access through to share markets and businesses in New Zealand and around the world. Do you think these announcements or the next few announcements are going to see a movement away from investment, and currently which is the favoured investment for Kiwis, maybe away from property into other asset classes?
Yeah, I do. And I think at the very least, it says to people that they have to go and reassess their portfolios. Is housing the only place they're going to make money? Or actually, is there a better option? What's their risk profile look like? Do they have another avenue that they want to invest in? So I think it does change the fundamentals. I think people do look out there, remembering, of course, that you don't get much money leaving it in the bank. So people are not wanting to do that. They're looking for a return. With these changes, they've gone from having a real rock solid return that they didn't have to worry about to just having to think about it. And I think when they think about it and they go, okay, it used to be quite hard to invest for a lot of people. Now it's not quite so hard. The access from Sharesies and that has actually been a massive change for the market. Maybe I will dabble with it a bit more. And maybe if the stock market is providing a fair return, or, I'm starting to make some money, maybe I'll keep going.
Thanks heaps, Brad. So changing tack a little bit now. I think we had you on, it probably was about a year ago. And, we're around a year on now from when New Zealand went into the nationwide lockdown. Can you tell us a bit around, how the NZ economy has fared through 2020 and what are we kind of expecting for 2021?
Yeah, absolutely. Look, 2020 was just an incredible year. Unprecedented was a word that was banned in our office because of how topsy-turvy things were. But essentially, we've had quite an interesting period. We had that first bit of COVID up until March, where it was a China story. And that was our big trading partner. We were worried about our exports. We moved into April, and for the next few months, where we had an alert level 4.5 week lockdown. We moved out of those, but we saw a huge collapse in economic activity. a lot of people couldn't go to work. We weren't building anything. We sort of put the economy on ice. So we had sort of an export focus to start with, a huge drop in activity. We moved into the third quarter of the year around September, and we were getting a good bounce back. People were allowed out of their homes. They were spending like anybody's business. Things were feeling good. Towards the end of last year, people just came off the boil a little bit. We'd done our big surge in spending. It was time to get back towards normal. As we enter 2021, we've got the economy in a pretty good position. We've lost tourism, but we've still got 90-95% of the economy rocking. The question is now, how do we regain that last wee bit? How do we get people back into jobs and similar? In my mind, with the borders still closed, 2021 is a bit of an up and down year. Things don't get a huge amount worse, but they probably also don't get a huge amount better, because we're still trying to restructure the economy. We've still got these big pinch points and pain points that are emerging. Once we start to get the vaccines rolling out towards the end of the year, we get a travel bubble with Australia going. All of those things put us on a better path, but that recovery takes a while to really get momentum up to sort of 100 k's an hour sort of thing.
Yeah, and so we're hearing a lot around economists talking around a K-shaped recovery. Are you able to explain what this means?
Absolutely. I mean, economists love to try and use really bad drawings of graphs to explain what's happening. You've heard about V-shaped, W-shaped, U-shaped recessions. The K-shaped one is essentially saying that because of how governments across the world have responded to COVID-19, that has favoured people who were already wealthier to become wealthier still. And if you didn't have wealth, you were left behind a lot more. Often, essentially in New Zealand, that means that if you're a minimum wage tourism worker, you've lost your job. If you're a big homeowner, your house has gone up in value by 20%. So the haves have gotten more, the have-nots have lost more. And so the K is sort of, if everyone was starting here, the have-nots have lost a lot, and the haves have sort of gone up even better. So it is meaning that overall the economy might be sitting in a better position, but the distributional hit, who's got something and who's lost something, is much more stark.
Yeah, thank you for that. And we definitely, is it around, I guess, the price of or the value of cash versus assets? Can you talk a bit maybe about that and how that might connect to New Zealanders?
Absolutely. Look, the big one for me is that over the last year, I would have been better to be made of weatherboard than skin and bones when it came to earning potential. And as I've said before, the technical term is cooked. That's just pretty insane. So what we've seen is that assets have gone up in value a fair bit. What people are earning in their jobs isn't nearly as good. Now, that's happened to both housing, but also the stock market. I think it's important to remember that a year ago, share prices were in a very dark position, down, upwards of 20% in some areas. A lot of that has come back, and a lot of our value is now actually above pre-COVID levels. Those low interest rates have really boosted levels of activity, and it has seen asset prices for stocks and for housing go up quite a bit. So people who have got onto the stock market are generally seeing a positive return. If you've just sort of got your job or not, things are a bit more difficult.
And so, we're talking about the recovery, and is the K-shape recovery something that we're seeing globally as well, or predict, or whether that's a terrible word, predicting or whatever. What else are we seeing in how international markets? We're expecting international markets to recover, and any other remaining barriers to economic recovery.
Yeah, it is interesting to see how things are playing out across the world. Every sort of central bank has done a fair bit of essentially money printing, which has sent interest rates diving lower over the last year. So we're seeing that K-shaped issue across most of the world. What's interesting is how different economies are faring. China is back towards growth. It's moving pretty fast again, because it did sort of what New Zealand did, which was a sharp shock and then pretty good recovery really afterwards. The rest of the world's still struggling. The US regaining a lot more momentum. Europe and the UK, though, still in a pretty difficult position. And as we sort of look at 2021, the vaccine rollout's the big thing that I'm interested in. The US has got I think I saw yesterday, nearly 30% already of their population immunised. That's a really strong start. The UK, who was one of the worst hit from COVID-19, getting a massive rollout going. That's fantastic. Europe, much more of a very different story. They're not rolling out the vaccine. In fact, they're starting to stop exports of the vaccine to other countries because they haven't got enough for themselves. So what it says is that there are going to be different ways that this recovery plays out. China and America probably recovering faster. Europe and the UK probably going a touch slower, taking a bit longer to regain that full momentum.
And you've talked a bit about the vaccine there and how that might help with the recovery. Thoughts on is that going to do what we think it's going to do? Is it the silver bullet that that it's talked about?
It's a big part of it. I mean, there are no silver bullets and no easy fixes for this pandemic, but it does get us a fair way along. The challenge is how quickly we can roll it out, both in New Zealand but also overseas. At the moment, government's plans in New Zealand aren't for that rollout to happen until July. Even then, there seems to be a few bits and pieces going wrong every now and then that do just make you question, are we going to be able to roll it out incredibly fast, or do we have a few hiccups? Across the world as well, we're seeing that developed countries are getting the vaccine rolling through relatively quickly. More developing nations, though, some of them might not have it for a few years. And so the question in my mind is, how does that work when we try to reopen the world towards travel, towards border crossings and similar? Because if you've got some of our poorer parts of the world who aren't able to get the vaccine, do they have massive COVID outbreaks? Do their healthcare systems get taken out? And are we actually able to reopen borders properly, or do we have to have some vaccine passports, only limited countries we can travel to? The vaccine's a start, but until we have a really good feel for where things are moving, I feel like there's a lot of balls that we've tossed in the air. We're not quite sure where they're landing yet.
And so speaking about travel bubbles, and we're all waiting to see what's going to happen with the Australia, New Zealand bubble. What do you think the impact this will have around on us, and also more specifically the tourism sector?
Yeah, it is going to be an important shot in the arm for the tourism sector, bringing back Aussies. That they're our cousins. We love to fight with them on the rugby field, but apart from that, we love having them in our country, and we love going to Australia. So I think it's important to recognise this is a bit of a two-way game. That we will be heading across the ditch. We'll also have some Aussies that come and visit New Zealand. It's an important amount of money. It's not insignificant, but at the same time, I think it's important to recognise that even if we reopen the borders after the Prime Minister's announcement on the 6th of April, that it's not going to be full resumption of business as usual pre-COVID. Flights are much more expensive. I'm from Whangarei originally, and it used to be that you could fly to Melbourne for cheaper than you could fly back to Whangarei. That's not going to be the case anymore. So I think for a lot of people, they're going to be saying, maybe I'll go for a trip to Australia, but maybe I can't afford it. Maybe I don't want to get stuck in lockdown if border changes happen again. So a good momentum starter again, but sort of not the full way, not the again that silver bullet. But I think for a lot of tourism operators, they'll be looking out for just a bit more help to tide them over. They've had a tough year. They've been able to get some domestic tourism support. Now they're looking for the next shot in the arm, the next sort of adrenaline rush.
Awesome. I've got a couple more international questions, or international general and economy questions for you there, Brad. So a couple of headlines that we've seen in the last week. One was yesterday, the 10-year US Treasury yields hit their highest point since January last year. You able to explain what the Treasury yields mean themselves, and also what they might mean for our investors who invest in the share market, particularly those that are invested in some of the growth stocks?
Yep, totally. So, I mean, the 10-year Treasury bond yields are sort of indicative of where interest rates are likely to move, because essentially they're a bit of a safe asset. They're a government bond backed by the largest economy on earth. They're a safe investment, and so they also tie into funding costs for banks and what the retail banks, ANZ and ASB, and that will pay for some of their retail rates. So they help set where interest rates are heading across the world. Now, they had previously been quite low. We talked about money printing before. That was because there was going to be low inflation, low interest rates really were needed to stimulate the economy. That's not really happening quite as much anymore. The feeling has been that the government, both in New Zealand, across the world, also governments are starting to pump a lot more money in. The new Biden administration passed a $1.9 trillion package to support the coronavirus recovery. That was a little while back. This morning, the White House announced a new $2 trillion package, and there's thoughts that there might be another $2 trillion coming down the track soon. So all of that saying, crikey, if the economy actually starts to grow again, then maybe we don't need as much monetary support. If that happens, maybe the Reserve Bank, the Federal Reserve, they'll raise their interest rates. If that comes through, it means that investment options will change. So essentially, the fear has become where previously we didn't think that prices were rising. We didn't think inflation was coming through. We didn't think interest rises were on the cards. Now there are concerns that interest rates will rise, inflation is going to go higher, and that's going to change where investing goes.
Awesome. The power of all that money printing just flowing through the system, isn't it? Yeah. Another one, this is slightly different again. So over the week, we saw a lot of headlines about a big container ship, the Evergreen, that was shut, that was stuck in a canal. Are you able to run us through the ramifications of that and what that means to how we have global trade? Like I heard there was 300 of these big cargo ships stuck and bottlenecked.
Yeah, I mean, essentially, you were trying to push an elephant through a needle at that point. You had so many ships that were trying to make it through this very narrow Suez Canal. We've got two major trading routes that go through canals: the Suez Canal, the Panama Canal. Basically, trying to cut out a huge amount of time to move ships across the world. Now, even prior to this, we had supply chain disruptions. We've seen container prices in New Zealand go up 400%. So essentially, it's become much harder to move goods about. People are getting stuck in different places. All those sort of challenges are emerging, which have sent prices a little bit higher for a lot of goods. The change or the issue with the Suez Canal is that it did create such a bottleneck. There were shipments that people were expecting, to come in at the end of the week. Well, they just couldn't get through. They weren't moving anywhere. And so for some people, they were waiting for goods, sitting there without, a kitchen table because they'd ordered it. But also some people who were selling goods that probably weren't able to make a lot of money because, well, they weren't going anywhere. So the supply chain disruptions that we've already seen could have been made so much worse if they hadn't been able to refloat the Evergreen. And I mean, the pictures there just showed how narrow it was. That's a big boat. It's a very small body of water. So it highlighted the vulnerability of our trade sector. What we're starting to hear now is that a lot of exporters and importers are actually holding on to a bit more stock. They don't know when the next shipment's coming in, so they'll hold a bit more back so they can supply into the market.
Thanks, Brad. We've covered so much good ground, and I think, and we're seeing lots of cool questions coming through. So we might switch and get into some of the questions. So a bit of a quick fire round. I'll just ask what's come through, and let's get into it. So
Right.
The first one is from Thomas. He has asked, do you see New Zealand entering into recession after the March quarter GDP numbers are announced? And what is your forecast for the NZ economy for the June and September quarters?
Yeah, we do think that things will get softer in March. We saw, a few bouts of alert level 3 here in Auckland. So activity is a bit softer at the moment. We're starting to see that there's just not that same momentum. Wouldn't get too worried about us re-entering what we're going to call a technical recession. It's just that the economy is bouncing around. So we're thinking that things are pretty volatile this year. The main point though is that the economy's made it back to 90% speed. It's just that it hasn't quite made it back to that 100%. So bouncing around a little bit, June and September, possibly a bit up, a bit down as we move through. But I think that at the moment we've sort of made it back most of the way, just not the full way.
I'll just ask a follow-up question. Talking about the New Zealand bouncing back to 90%, based on where we were a year ago having this conversation about the New Zealand economy, do you think that it, is more optimistic or than you were thinking at that point, or how is that sitting for you?
Yeah, absolutely. I mean, the resilience of the economy, the ability for us to bounce back has been impressive and shocking in a sense. We were not ready for it. It came through really strongly. And what it also says is that it does make me a lot more upbeat and optimistic about this year. We're not thinking that things, are rapidly returning to normal, but we're in such a good position that starting position gives us a good base. It's a good foundation to springboard away from. So I think that this year is looking up. It's certainly not looking as bad as we were thinking last year. We're not fixed, but we're not stuffed either.
Cool. So this one's from Danny, and they're wondering how coupled our economy is to the US one. If a stock market crash occurred in the US, how would this have a flow-on effect to Kiwi stock and bond markets?
Yeah, we are. I mean, the US is just such a big market that it will affect us in some regards. It depends a little bit on what's driving things. So those international bond rates, the US Treasury yields and similar, they will influence where our bond rates go. They will influence where people are looking to put their money. But, if we were to see a collapse in the US stock market, if it was driven by, some financial crash, like we saw in the GFC, it would definitely come through. If it was a more geographically limited issue, it could actually see our stocks go higher because there was a feeling that the economy has moved better. Now, I say that in terms of looking at where the US and NZ economies move is quite important. The New Zealand dollar at the moment is quite a bit higher, essentially because we've been doing better than the US economy, and so that's sort of seen as a better mark of economic activity. So we are very much tied to them. Sometimes it helps us, sometimes it hinders us, but yes, we've got to keep an eye on it. We're not obviously coupled at the hip, but we're interacted enough, given that sort of global connection, that we have to keep an eye on things.
And so this one's from Dylan, and I'll take this moment to reiterate that nothing we say here is personalised advice. But Dylan has asked if you had a spare thou to invest today, where, who, and why would you be putting it there? So feel free to answer that however you like.
Look, personally, I'm a bit of a defensive investor, and I think the thing that I always look at, depending on what it is that I'm wanting to do with that money, is, am I going to be wanting to move it around quickly or not? I mean, there's still, I think, a fair bit in some of the climate stocks at the moment. There's big energy changes coming in New Zealand. At the moment, there's also some pretty good pickings when it comes to stocks that are in a softer position that could well come back better as the economy improves. So I think in general, looking at the stock market would be the primary place. Look, I just don't have enough money for an investment in a house at the moment. So, putting cash into the markets is certainly an area. But I think, as you said, I mean, general advice, but also worth looking at what you're interested in, because I think what we're starting to hear a lot more of is that people are interested in different areas. They might want to be looking at tech, they might be looking at energy stocks, there might be some retail offerings that come through. So there's enough out there for you to have a bit of fun in the market.
So the next one's from Carol. I have some Australian shares in ecologically sound businesses and sustainable products. They have recovered well since April 2020. Have you noticed any trend in how NZ green businesses are recovering compared to other businesses?
I think we're seeing a lot more interest in sort of, sort of greener options. I'm going to call them options because it's not just businesses, it's ETFs and everything else. There is sort of that look at maybe when we look at investing, it's not only about what's happening purely in the financial area, but what are the sort of social sort of outcomes and the environmental outcomes for people. Importantly, because we've had this big shift around the world in terms of that focus on climate change, the US has rejoined the Paris Accord. New Zealand, we've got our Climate Change Commission reports coming out. There's a focus on actually there's money to be made in those green areas. There's also, an ecological, environmental, and social responsibility coming through. So for a lot of people, there is a huge amount more interest in those areas, and we have seen some pretty good numbers coming through.
Thanks. So this one is the euphoria into new investments not a dangerous line to walk following current local and global economic situations? Has the feel of a dot-com bubble, but with newer asset types and investments that are trying to, I'm not quite sure I understand that second part, but I think we get the gist of the question.
There's a lot of energy in the market. People are coming in, people are trading around, they're looking for options. Is it scary? Yeah. Yeah, you've got to keep your wits about you. You've got to think about that risk in that. But I think as well, you look at where we've put our money in previous times, and I mean, the dot-com bubble. What about the housing bubble we've got at the moment? So I say that because I don't think anything is sort of as gold-plated or fine and dandy as we might think. We've got some big changes coming out there. We've got a lot more people who are looking into the market. It used to be very much that investing was a game for the big end of town. As we saw with GameStop and similar, people are looking to do things a lot more by themselves. There's a lot more sort of smaller investors out there looking around. So there's more interest, there's more trades happening. You've just got to keep your wits about you. And I think it's important that people sort of do think about that risk. There's no such thing as a free lunch in any economy. So sort of considering where things are going means that you can at least recognize when things might be getting outside of your risk area, and where you might want to pull back or change tack.
So the next one's from Jill. What stocks can you suggest for potential growth in the long term? Talking 25 to 30 years.
Crikey. All right. I feel like that's quite an interesting point. I think the areas that it sort of depends on. There's some energy stuff that I think has quite a lot of potential there in terms of that climate focus and what we were talking about before around sort of some of the greener options. There's also quite a lot of focus on a little bit more of the tech-based activity. The weightless economy is a big trend at the moment. People are looking for those different options. When the world is physically limited, how do we still stay connected and similar? So I think there's some interesting options coming through there. Of course, there's still a fair bit of risk with some of those. Who actually manages to make it over the line to 20 years and who sort of falters or changes before then. As well as that, though, I think it's important to recognise that there are some products and some asset types that are always going to be well in demand, and because of that, they sometimes have a lower return over time, but they're also seen as a bit more stable and solid. People think about different energy stocks, maybe retailers, retirement, home options, all those sorts of things are the sort of areas that people are looking to park their money in. Increasingly, I think we're seeing people who want to back a local company as well. So there's still that interest in what is the local market doing, as well as what's providing the money from an overseas point of view.
Thanks. So the next one is from Gary. Do you think that the government takes enough notice of the value of the tech industry in New Zealand?
Oh, absolutely not. And part of that's because it's so hard to value. It's so hard to sort of understand what's in there. I mean, look, if I buy a box of apples, I can count all of the apples. Very simple. I can't count a software. That sort of thing is just very difficult. So I don't think the government fully understands that. More importantly, I don't know if the government or the business sector generally spends enough time understanding what the digital realm can unlock for us. We saw during lockdown how important it was to have that sort of digital offering, whether it was an online store, video conferencing options, online platforms for different bits and pieces. There was a lot in there that got businesses moving very quickly. It's a sort of area where you can sort of go fast and break things. You're able to sort of make those things change. And also, I think the barriers to entry are quite different. They're quite low in the tech space. So once you have a good idea, that's generally you're able to at least put it to proof of concept stage and then see if there's enough interest out there. So we don't take enough account of it. I think we need to take more because it is, in my mind, an area that we can grow quite a lot. It also isn't as resource intensive. If we're able to create software and similar, yes, we've got to power it, but it's not taking things out of the ground that we can never replace. That's an attractive option in my mind.
And so the next one's from Gary. Do you think that there were sectors that were inefficient pre-pandemic but are efficient now? And do you have any examples?
Oh, I mean, there's always parts of different sectors that are inefficient. Do I think they're actually necessarily efficient now? Probably not fully. I think there's still a lot of spare capacity going around, so we haven't fully hit our strides yet. I think what has changed is that we're looking for more efficiency, whereas previously we were happy to just coast along with higher growth. Tourism's quite a clear one there, had a lot of activity going, is now having to consolidate itself, figuring out what's next. I think actually the healthcare sector is an interesting one because it was always such a big behemoth beforehand, and now we've understood that actually we need to be able to respond and react quite rapidly. We've got to have different IT solutions. We've got to be able to vaccinate the team of 5 million shortly. Have we got the tech assets to do that sort of thing? So I think there are areas where people are looking for more options. They're looking to streamline activity. I don't think it's going to be a quick fix. It's not the sort of thing we click our fingers and do overnight, but some sectors are definitely looking at it. Retail and hospitality are probably other areas where they were a little bit easier to rest on their laurels previously, now having to look for slightly different options. So the jolt of COVID-19 has sort of energized people to look for different things.
Yeah, fantastic. I've just noticed the time, so I think that was our last question. Thanks heaps, Brad. Such an awesome, you're very talented at breaking down lots of jargon. So thank you for being here. I'll pass to Gus now to wrap us up.
Yeah, thanks everyone for tuning in, and a very, very special thanks to Brad for your time. We love having you on Lunch Money the second time now, and look forward to having you back again soon, hopefully in the future. Also, a reminder to everyone out there that Sharesies are bringing Australian shares very soon, and you can register your interest for early access through our website. Have a great long weekend, everyone. Enjoy the eggs.